Danske Bank is launching a new sustainable equity fund called Global Sustainable Future. With me on link today I have Martin Slipsage Fransen and Simon Christensen, leaders of the investment team, to talk more about this. Welcome to the show. First, Martin, could you describe in a nutshell what the Global Sustainable Future Fund is all about?
Yes, I will. Thank you. So my name is Martin Slipsage Fransen, and we will talk about Global Sustainable Future. The overall theme in terms of Global Sustainable Future is that we want to invest in the companies that are best positioned to lead and benefit from a transition to a sustainable future. So that is companies that through their products, through the services, and through their supply chains, that they will be in a position to contribute to solving the world's sustainability challenges, and at the same time be in a position to materially generate value for both society and for the shareholders at the same time. So this is a fundamental strategy where we try to invest in between 30 to 40 companies. We do that through a rigorous investment process based on especially the UN Sustainable Development Goals. And we do that so that we can identify the companies best positioned. When we have done that, we set targets for each and every one of these companies, targets that we call for critical contribution points. And those are the points that the companies, they need to deliver on in order for us to stay invested, so that we can make sure that these companies continue to contribute towards solving the world's sustainability challenges and the transition towards a sustainable future. This is not a matter of philanthropy. It's because we believe that this is good business. We believe that this will lead to good value creation opportunities for the companies, and we want to invest in the companies that are best positioned to address this. This also means that we think about risk management. We think about our investment process in the same way that you would do that usually in a stock picking strategy. So we want to beat the MSCI World, and we want to do that in a way where we can create sustainable returns for our shareholders. Now, we are two people on this call today from the Global Sustainable Future team, but we are actually a team of 6 people that are focusing on this strategy. And in addition to this, we also have the support of Danske Banks ESG team, which today consists of 16 people that help us with our investment process.
So Simon, the Global Sustainable Future Fund is a thematic fund. Which themes are you pursuing?
Yes, it is a thematic fund. We invest according to 3 themes. The first theme is what we call climate stability. And if we look at the world today, we are facing a situation where the degrees will increase by around 3 degrees if we don't live up to the Paris Agreement. So the climate stability theme is focused on investing in companies that can contribute to living up to the Paris Agreement and lowering the greenhouse gas emissions. This could, for example, be a utility company which has ambitious targets for rolling out their renewable asset base. The second theme that we invest in is what we call natural capital. Today, we consume more than 1.8 times the resources that the globe can regenerate. So if we look forward to the year 2100, we will be around 50% more people. So that number, 1.8, will only increase from here if we don't do something. So the second theme here is focused on investing in companies that can address this problem, for example, through increasing the efficiency in production and the efficiency in how we consume. We also focus on addressing what we call the water crisis, where more than 2 billion people live without access to clean water and sanitation. Now, the last theme is what we call social equity. Today, more than 50% of people around the globe do not have access to any kind of social welfare system. In addition, although we have made a good progress, there's a lot of poverty in the world as well. This theme is focused on investing in companies that can contribute to raising the social foundation globally. For example, through investing in a company that can provide better access to the healthcare system, but also better healthcare outcomes through better medicine, for example, through pharmaceuticals. That was shortly around our 3 themes. We are invested in all geek sectors, more or less. And all the three themes, they are linked to the UN Sustainable Development Goals.
So Martin, how do you select which equities to include or exclude in the fund?
That's a great question. For us, the most important thing is to invest in the companies that are best positioned to lead and benefit from the transition to a sustainable future. So companies that can contribute with something meaningful to solving the world's sustainability challenges, while at the same time creating value for shareholders and society at the same time. In order to do that, we have created a rigorous investment process based on the UN SDGs, where we try to find the companies best positioned. In order to do that, we use three quantitative tools, and from there on we use our fundamental work. But the three quantitative tools are tools that scores companies on quality, and also scores companies on the extent to which they perform on the most important ESG topics. When we then have used these three tools, we get to around 300 stocks, and there the fundamental work starts. So we do in-depth fundamental analysis on all our companies to make sure what they say is what they do, and make sure that they actually will contribute and benefit from the transition to a sustainable future. An example of this could be the UK utility SSE, which is a company that have developed an 8 gigawatt pipeline of green energy, primarily offshore wind. If you were to build these 8 gigawatt, then that would result in green power and electricity for around 6 million households in the UK. So that is quite a large contribution if they will actually build this pipeline. That is, of course, one attraction for us. But when we started to invest in SSE, it was a transition company for us, given the fact that the company still had a bit of coal exposure in their energy mix. We, of course, didn't like this coal exposure, and therefore it was a transition company for us. And the way that we worked with this was that we set a target, a critical contribution point, what we call it, that they should address this and close their last coal plants. Then we went into dialogue with the company, and they could tell us that they were aiming to do this by March, end of March this year. They delivered on that, and which this means that they would address their negative contribution. And we were, of course, happy about that. And this 8 gigawatt pipeline, that's, of course, attractive as a shareholder if they would actually build it. And therefore, we did an analysis of the seabed area around the British Isles. We compared the amount of capacity which is able to be built in at this point around the UK Isles, and we compared that to the UK ambition of building 40 gigawatt. That gave us a lot of confidence in the fact that SSE will actually deliver on this 8 gigawatt pipeline and therefore contribute with green energy to 6 million households. That is an example of a company that we chose to include. An example of a company that we didn't include in the portfolio is a company called Kellogg. And Kellogg is a company that most people know for their cereal brands, and they also own Pringle. And that in itself is probably not the most sustainable foods from a social perspective. But the reason why we were interested in Kellogg is the fact that they own one of the most successful plant-based food brands in the US. It's called Morningstar Farms, and it's quite a successful brand with the largest recognition from the public. And plant-based food is great given the fact that it addresses some of the negative environmental perspective of agriculture and meat consumption. And therefore, we quite like this part of the business. We also like that Kellogg is one of the companies that actually take the environmental footprint very seriously and address this. But given the fact that we could not see a visible path where they could actually contribute to healthy living by addressing the negative health perspectives of the cereal brands and the Pringles brand, so chips. We did not invest, given that we could not see a transparent and visible path for them to address this. And we could not see this because we went into dialogue with the company, and they told us that it would be very, very difficult for them to address this, which is also fair, but then it does not add up for us from a sustainability perspective, and therefore we did not invest in the company. So we invested in SSE because they had a large opportunity to contribute positively through green energy, and they could address their negative contribution from coal. We didn't invest in Kellogg because we liked that they could contribute positively through their plant-based food, but we didn't invest because they could not address the negative contribution from their own unhealthy brands. So those were two examples of what we chose to include and not include in the company, in the portfolio. Sorry.
So, Simon, I know that some investors are worried about inflated asset prices in sustainable companies. How do you handle this?
Yes, thank you. That's a good question. First of all, I must say that in the Global Sustainable Future Fund, we think about sustainability more broadly. That also means that we invest in most sectors. That gives us a very good diversification in terms of risk, but also in terms of the problem that you raise here, so we don't squeeze ourselves into some niche sectors of the market where sustainability can push up valuations to the extent that the companies are not relevant for us to invest in. We simply have, as fundamental investors, models on all the companies that we are invested in and have a very good view on what is the fundamental value of these companies. Lastly, I would also point out that if you look at our portfolio today and look at it relative to MSCI World or the market, you can see that our portfolio is a little bit more expensive than the market. When we dig into this, we can see that if you take an average of the companies that we are invested in, they have better profitability measures, i.e. EBIT margins, return on equities, etc. They also have lower debt levels, and if we look at it, they also have better growth prospects. So we actually believe that the reason why our portfolio is a little bit more expensive is due to it is higher quality in terms of profitability and in terms of growth.
So Martin, what opportunities do you think sustainable investing brings along for investors?
That's a good question. Firstly, we believe that sustainability is one of the things that will define the coming decades. And it will define the coming decades both in terms of how we invest, how we produce, and how we consume. If we are to actually achieve a sustainable future, we believe that this will lead to material opportunities for the companies that we invest into. We use the UN SDGs as part of our investment process, and the United Nations, when they set out these in 2015, they themselves estimated that this would lead to around 12 trillion of American dollars of market opportunities for the private sector. That is, of course, a very large number and something which can be a bit difficult to relate to, but it's roughly the same size, or a bit smaller than China's BNP today. So that is a huge investment opportunity for the companies that digs into this. And the important thing for us there is that this was something that will be long-term and large, and something that companies need to relate to. And if we are to achieve sustainable development, then the companies that dig into this opportunity pool, they will be in a position to materially generate value for shareholders and society at the same time. And we see that across industries. There's, of course, companies better positioned than others, and those companies are the ones that we want to find and invest into in our strategy.
And what are your thoughts on the future of sustainable investments, Simon?
Unfortunately, I think that the problems that we are addressing in the Global Sustainable Future Fund, they will not go away overnight. So I think there is a lot of work of addressing these problems. That is, like Martin said, rethinking how we produce, rethinking how we consume, and rethinking how we think about the sustainable or the social foundation globally. In addition to that, we also see asset owners around the world adopting more sustainable ways of investing. We also see governments increasing their targets with respect to sustainability. So I think going forward, sustainability will become ever more important when you invest.
And how do you think the COVID-19 pandemic has impacted sustainable investing?
Well, the COVID crisis has impacted a lot of things, but of course also sustainable investing. I think sustainable investing has become even more relevant after COVID. What we have seen is that, and what you typically see during economic crisis, that is the social inequality actually increase. For the first time in more than 20 years, we actually see the number of poor people living for under $2 per day has actually increased here in 2020. In addition to that, we can see that the healthcare system has actually been disrupted as well. We see that more than 70 countries around the world, they actually have halted vaccinations of children. And that is, of course, a very important thing to address. when you think about sustainable investing going forward. So COVID has made it much more apparent that we need to invest more sustainably.
So let's go back to the fund, Martin. You've decided to never invest in more than 40 companies. This is partly because you want to be able to have a close dialogue with the companies. What are your thoughts on active ownership?
It's a very important part of sustainable investment being active owners, and it's completely right. The reason why we have 35 companies today in the portfolio is that we can be very close to our companies so that we can actually get to know these. We can be active sparring partners for them, and we can set these targets that we call critical contribution points. So given we have these targets, we have sort of an onset from which we do our active ownership. So we make sure that the companies actually progress, for transition companies that they actually address their negative contributions, for ESG leaders that they actually maximize their opportunities, in terms of contributing towards a sustainable future. That is active ownership in a nutshell. We want to be active owners that are sparring partners, and therefore it's also very important for us to be long-term investors. We aim to have around 4 years of average ownership at least in our portfolio, and that means that we can be long-term sparring partners for these companies. When we meet management, the CEO, the CFO, we can make sure that they actually have the right mindset and that they will continue to contribute. And I believe that is very important given the fact that a lot of the ambitions in sustainability are quite long-term, and therefore it is not always the same management which actually has to live up to the targets that the companies they set, and therefore it's very important for us to get to know the companies so that we can make sure that it's a matter of culture and it's a matter of the company's DNA, so to say, that they actually are sustainable companies and that they will continue to contribute towards sustainability in the future. For us, it's also very important as investors to have a focused portfolio, given the fact that we can offer a high active share, and combining sort of a focused portfolio with a long-term horizon. It also means that we can be very picky in terms of choosing which companies we actually want to include in our portfolio. We can do a lot of fundamental work, and then we can choose only the ones that we believe are particularly well positioned to lead and benefit from the transition towards a sustainable future.
Simon, before we wrap up this interview, how has the performance of the fund been so far?
Yes, well, since we started the strategy a little bit more than a year ago, we have been able to beat our benchmark or the global market by roughly 10%. This year we are up by a little bit more than 7% as well. So we are, of course, very happy about that. What I think is even more important is that when you think about sustainability and the growth opportunities that arise out of that, we are far from done. We believe that over the next decades, there will be significant and good investment opportunities in sustainable investing. And we look forward to giving our clients competitive returns while at the same time contributing to society and a more sustainable future.
Thank you very much to the both of you for joining me today and telling me more about Danske Bank's new sustainable equity fund.
Thank you.
Thank you.